Okay, guys, so welcome to tonight's session. This is Fact 4862, Fact 4864, and this is week 13. What we'll be doing, we'll be covering an overview on cash flow statements. So for tonight, I'm just going to take you through the format of cash flow statements, how to get to the different numbers, just on a discussion point of view. We're not going to do actual calculations. And then in the next lesson, we're going to do a cash flow question. Like I said, for CTA level 1, there's a good opportunity to get a good mark for fact 2, which is you can get like basically 60, 70%, if not 80% for fact 2 because of cash flows. So it's a really good opportunity. For CTA level 2, fact 4 students, not that of a big opportunity because cash flows are not necessarily going to be such a big percentage of the question paper. What's going to be another big part is foreign subsidiaries. Okay, but we will cover that in week 15. Okay, so now I'm going to switch over into Google Sheets, and then we're going to go through the format. And as we go through the format, we're going to explain the thinking behind it and how to think through the cash flow statement, what are the possible line items, and then how to go about calculating it. So it won't be long, probably about 50, 60 minutes. And then we will shut down for this week. Oh, not actually, tomorrow and Friday and Saturday as well. But we will shut down for tonight. Okay. So I'm just going to share my screen. So you should be able to see the screen. Okay. So what you should know is that the purpose of the cash flow statement, there's various reasons. Okay. So probably the main reason is to provide an explanation of how cash was earned and used by the company, right? So remember the income statement, the balance sheet, and the notes of the financial statements are all prepared on the accrual concept. The accrual concept gives you absolutely no indication of what is the cash situation of the business. And that is where the cash flow statement comes in, to explain or to demonstrate the cash situation of the company. The cash flow statement is basically another reason to, or another way to look at the cash flow statement. It is a way of reconciling the business's opening bank balance versus the business's closing bank balance. So remember, right at the bottom, we will see the following. Okay, so right at the bottom, we will see the following. So what do we see right at the bottom? I don't know why it's not moving. Okay, so what we will get, cash and cash equivalents. Cash and cash equivalents, okay, and this is basically end of year or end of the period. We work in years, so I have to say end of year. Okay, so we will get to that number, opening cash and cash equivalents, end of the year. But what's going to be, we're going to compare it to cash at the beginning of the year. Okay, we're going to compare it to cash at the start of the year. So what you must know, what you should know, that the net movement in cash and cash equivalents plus the cash at the beginning of the year, the cash and cash equivalents at the beginning of the year, those two will make up your cash at the end of the year. So if you think about it carefully, all we are trying to reconcile, as we will think of it another way, we are reconciling the opening balance of cash and cash equivalents at the beginning of the year with cash and cash equivalents at the end of the year. So how did cash go from the beginning to the end? And we get that by getting the net movement. Now the question is, how do we get the net movement? The net movement is split into 3 phases, or as accounting called it, we call it 3 activities. Okay, so we basically split it into 3 activities. So what are the three activities? Is basically cash flows from operating activities. It is cash flows from operating activities, cash flows from investing activities, and then cash flows from financing activities. Okay, so the cash flow statement explains a lot, right? It's a very key statement. Like we said, income statement, balance sheet is all the accrual concept. So there's no statement that explains to us how is the cash situation of the company. So that is where the cash flow statement comes in. It demonstrates, it illustrates, it explains how, what did the company do with their cash? How did they earn? How did they receive cash? And what did they use the cash on? Okay, so that is important. So basically, it's a reconciliation between opening and closing balance, and we get the net movement. That net movement is basically made up of three activities. So this answer over here, that answer, net movement in cash and cash equivalents, is the sum of these three balances: operating activities, investing activities, and financing activities. So very, very important. So here's an important aspect to take note. Okay, so you can, it's an easy 1 to a half a mark to a 1 mark, very easy. Remember, we said that net movement plus opening cash and cash equivalents must equal closing balance. Okay, what you will know, you will slot in opening balance, which is going to be given somehow. You will slot in closing balance, because it's going to be given somehow. So that plus that must equal the closing balance. But what, this is very important. Don't make up this number to be opening. Don't make this number to be closing minus opening. What this number must be, you must show it to them that it is the sum of these three. So very important, this must equal A plus B plus C. Okay, so this here is A, that there is B, and that there is C. So very important, even if net movement plus opening balance does not equal closing balance, always ensure that your net movement is equal to that sum. There's going to be a mark for it. So they're going to check that the sum of this equals your net movement. So even if the sum of that does not result in this plus that equaling that, it just means your cash flow statement is not right, but just show that your net movement is the sum of the three. Very important, eh? Very, very important. Now we will break each one down. For CTA level 2, over here, we will include something else as well. I'm not going to bring it in now. I'll bring it in when we do foreign subsidiaries. So it's going to be a foreign currency translation over here, but I don't want to bring it in. For CTA level 1, you don't cover it. Okay, so for CTA level 2, we'll bring in another line item over here. Okay, so I'm going to ignore it for now. So now let's have a look at each activity. I'm going to start bottom up. Okay, so I'm going to start with financing, then investing, and then operating. So what you should know, that the financing activities, if you look at the accounting equation says assets equals equity plus liabilities. So assets equals equity plus liabilities. The asset side represents your investments. The other side of the equation, equity and liabilities, represents your sources of finance. So your financing is all your sources of finance, but not any source of finance, only your long-term sources of finance. So under the financing activity, we will see anything relating to share capital. We will see anything relating to So either you had a share buyback or you issue new shares. Okay, so if it's new shares, it will fall under financing activities. Why? Shares forms part of your long-term source of finance. Similarly, under financing, there will be long-term loans, there could be debentures. So remember how the items that would fall under the weighted average cost of capital, that will basically fall under financing activities. So very, very important. Now, here's an important aspect which you must be aware of, both CTA level 1 and CTA level 2. That in test 3, you covered change in ownership. Now, remember, there was a change in ownership scenario where before and after the change in ownership, you were still a subsidiary. Before the change in ownership, you were a subsidiary. After the change in ownership, you are a subsidiary. What did we call that? We said that was a transaction amongst the owners, a transaction between the parent and the NCI. So any cash flow in a change in ownership transaction like that will also fall under financing because it is a form of financing, right? It's fall under, it is relating to shareholders. Shareholders is a form of finance. Long-term liabilities is a form of finance. So very, very important. So when you look at the balance sheet, all equity is under financing and all long-term interest-bearing debt is under financing. So your typical examples over here would be as follows. This is typical examples, so you won't be able to set up a format exactly. What I usually do, I'll set up the format as I have it over here, and I will leave spaces. Okay, so I will leave spaces. I didn't want that. I will leave for financing, you will leave about 7 spaces, okay, that will make up the different items. So for example, what can happen over here? Share buyback. There could be issue of new shares. Okay. Proceeds. From issue of new shares. Remember, when you make money in cash flows, we call it proceeds. Okay, so just take note of that. Okay, so share buyback, proceeds from the issue. When you issue shares, you make money, so that is proceeds. Another example would be so if there was a change in ownership before and after you are a subsidiary, okay, so that is a transaction amongst the owners, which is parent and NCI's equity. So it will fall under financing activities. So what you will have to do over here, what you will be over here, you will, so if you are increasing your shareholding, in order to have increased your shareholding, you must have paid, the NCI for the shareholding. So you will say payment, whatever you want to call it, I can't remember the name. So payment for increase in shareholding. So remember, what's important, you're busy with a cash flow statement. So only cash flows can come in over here. Only cash flows can come in over here. So if you increase your shareholding, but there was no cash flow, you can't bring it in over here. Very, very important. If there's a change in ownership, and the change in ownership result before and after you are a subsidiary, that means it is a transaction with the owner. Because it is a transaction with the owner, it will fall under financing activities. So if you decreased your shareholding, that means you sold a portion. So what would it mean? You would have made money. So you would say proceeds from decrease in shareholding. Okay. Okay, so just take note of that. So that is basically typical equity numbers. Okay, increase in shareholding, decrease in shareholding. Remember what you want to show whether it's an inflow and outflow. If you make money, it's an inflow. If you pay out money, it is a outflow. Okay, so inflow will not be in brackets, outflows will be inside of brackets or negative. So remember, you can also make, so financing, this is equity. But remember, the other form of financing is long-term liabilities, debentures, long-term loans, bonds, so forth, preference shares, so forth. Okay, so just take note of that. So if you are making money from a loan, you will say proceeds from long-term loan. If you are making a payment, you will say repayment of long-term loan. Okay, so these are typical examples. So just be very, very aware of them. Okay. So these are basically examples. So I'll leave it at that. So remember the key principle, if it is financing, it is equity and all long-term liabilities. Okay, so any liability that forms part of your long-term sources of finance. If it's a bank overdraft, if it's trade payables, anything that is anything that is part of your operations, anything that is part of working capital will not fall under the financing activities. So you can kind of apply the same thinking when we do in WAC. Okay, so very important. Here's one more aspect that is very important on this level, is that dividends and interest. So remember, when we did cash flows in first year, second year, third year, then dividends and interest was generally included under operating activities. That is correct. However, the accounting standard on cash flow statements, the standard is called IAS 7, cash flow statements, right? Or statement of cash flows. That standard gives the company the option as to where to actually include interest and dividends. Now, dividends paid can be included under financing activities because remember, you pay a dividend to shareholders. Shareholders fall under financing. So therefore, it can be included under financing. Similarly, interest on long-term loans, any interest paid relating to long-term source of finance can also be included under the financing activities. So just take note of that. The question will make it clear what is the company policy. The company will choose a policy. So any dividends paid can be included under financing activities, and any interest paid, but only interest paid relating to long-term source of finance can be included under financing activities. So for example, you have a long-term loan and you paid interest on the long-term loan, you can show interest paid over here. You have shareholders, you have preference shareholders, there may have been a dividend payment. You can include the dividend payment under financing activities. But that is a policy choice, so you must read the policies to see what the company says. Okay, very important. Now we go to investing activities. Okay, so now we go to investing activities. So now we go to investing activities. Under investing activities, oh, just one more thing under financing activities. One more thing under financing activities. For the long-term loan, they will most likely only give you the proceeds or the repayment. Remember, it's very important that you must get both amounts. It's a requirement that you separately disclose the money you made, the proceeds you received from loans, and the money you paid as a result of loans. Okay, so any repayment of a loan and any proceeds of a loan must be shown separately. So they're generally not gonna give you both. So you're gonna have to work out which one. You have to work out the other number. So how are you gonna do it? in any cash flow number, you must reconstruct a T account, okay? But I'll explain that when I come to operating activities. Now we come to this over here. Under investing activities, remember it's typically going to be proceeds from sale of PPE. Just so you know, you will generally say from PPE or something like that, and you kind of have to say, okay, so it's proceeds from sale of PPE. Then if you acquire it, you will say acquisition. Acquisition of PPE. It's kind of a requirement from IFRS to separate between whether the acquisition was a result of maintaining the business or whether it is as a result of expanding the business, okay? So then you must separate. Just a quick note, from a UNISA point of view, if you look at their solution, so whatever I realized, they don't say PPE, right? They will separately show every PPE. So machinery separately, vehicle separately, land and building separately. I'm only saying PPE, but in an exam, when you practice, you can't combine them for UNISA's purposes. In the real world, you combine them. UNISA likes to have separate line items. So land separately, building separately, machinery separately, equipment separately, vehicles separately. Okay, so just be aware. But what is technically correct, that's fine what they are doing. But what is, what you call it, you just need to show acquisition of PPE, maintenance, acquisition of PPE, expansion. For their purposes, you will list the specific PPE. So acquisition means you made a payment, so it's an outflow. Proceeds you sold, so it is an inflow. And the same principle applies to any intangible asset. Now, what happens over here? Here is the big difference when it comes to groups. Okay, so this is going to be a cash flow statement on a group level. You're not going to get the company level cash flow statement. You're going to get a cash flow statement from a group perspective. Okay. So the only difference over here, remember I said, when we do cash flow statements, we assume everything is on credit. Okay, so when we do a cash flow statement, when you prepare a cash flow statement, you assume everything is on credit, and the balancing figure from your calculation would then be the cash amount. So what do we do? What do we do is we do a cash flow statement by reconstructing the T account for every balance on the trial balance. So you go through the trial balance, and every account on the trial balance, you must set up a T account. Then they'll most likely give you an opening balance, and they'll most likely give you a closing balance. So what you do, you set up your T account for each balance on the trial balance, right? For each account on the trial balance, you slot in opening and you slot in closing balances. Then you will go to the notes to the financial statements. I mean, the additional information, whatever they call it, notes, additional information. And then you go line by line. As you read point number 1, you go affect the relative account. As you read number 2, you go affect the relative account. What's important to take note? When we read the additional information, we would then be reconstructing the T account. So now what's important to take note, reconstructing the T account implies you need to know exactly what goes into each account without even looking at the scenario. So when you look at this balance over here, so you can see it's PPE, you must be able to reconstruct the PPE account as you're sitting over here and say, and know what goes into the PPE account. Opening balance, closing balance. Additions, so this would refer to additions over here. There can be a disposal, that could be the disposal over there. There can be depreciation, there can be impairment, there can be borrowing costs, there can be for CTA students, CTA 2 level students, foreign transactions, And this is the important one for both CTA level 1 and CTA level 2. If you acquired a sub during the current year, then you must bring in the subsidiary's asset. So if you acquired the subsidiary and the subsidiary had PPE or machinery, then you will have to bring in that line item. So basically, I'm not going to go through it now, but when you do a question, we're going to reconstruct it, every single T account. That is why I didn't want to do a question, because we're going to need 2 full hours to do a cash flow question where we reconstruct every single T account and we go through the notes. But by reconstructing the T account, before you even reconstruct the T account, you must know all the possible transactions that can go through the T account. I use a T account. You don't have to use a T account. You can use a table format, like a note disclosure format. We can do that as well. I'll show you how to do both ways, but basically you must be able to reconstruct a T account in order to get the cash flow number. If you leave out any line item in the T account, your cash flow, your balancing figure, which is your cash flow number, is going to not be right. And that would cause that when you add up net movement plus opening balance, it won't equal to closing balance. So what's important is that you must be able to reconstruct the T account. In one of the ITC exams, I'll see if I can find it. I must see if I don't know if I can find it actually, but one of the ITC exams, our UCT's Accounts 3 lecturer, so at that point in time, he was my Accounts 3 lecturer. So remember how ITC works. They would have people that they would ask lecturers, whoever is part of setting papers, they would ask lecturers to set the paper. So what they would do? Let's say they identified 4 lecturers in accounting. They will approach each lecturer. Let's just assume each lecturer agrees. Okay, so they tell each lecturer prepare a question. So they'll tell you what question they want. So in that particular question, they asked the lecturer to set a cash flow question. So there's, let's say, 3 or 4 cash flow questions being set. The lecturer does not know whether their question is selected or not. They will only find out on the day of the ITC exam. So the cash flow question, and it happened to be the first cash flow question that IT Psycho tested after a long few years, happened to be the UCT's Accounts 3 lecturer's question paper. And basically, it was a 100-mark cash flow question. You needed to know your entire syllabus. So obviously they gave a cash flow question to us as UCT students through the year to do it. And he told us actually that the hardest part of that cash flow question, so he's a very cocky guy, okay? So he said the hardest part of that cash flow question was setting the paper. So he said the actual paper was easy because he gave you everything. We were just filling in the missing numbers, meaning to reconstruct the T account. And the hardest part of that question paper was for the person setting the question paper. So I'm going to see if I can find it. But what you will notice is that you needed to know all your work. Okay, you needed to know all your work. And he said actually Psycho made it easy because when he set the question paper, he set the paper and he had the required read as follows: prepare the cash flow statement, 100 marks. That was the required. When the exam came out, he realized it was his question that Psycho put in, but Psycho did a few adjustments. Psycho broke up the question into 2 parts. Psycho said, dear student, please determine the cash from operating activities. Then Psycho said, dear student, determine the rest of the cash flow statement. So they broke it up so that it's more manageable, where he said when he set it, it was 100 mark, prepare cash flow statement. The second thing was, and this is where the CTA 2 level students will come in. Remember I told you we're going to insert another line item over here. So when it comes to foreign subsidiaries, you're going to have to make a foreign adjustment to the cash balance over here. We will do that. I'm not going to do it over here. I'll do it when we just have CTA 2. He never gave that number, and where Syker gave the answer. So Syker at least gave you that number, so it was at least some kind of a starting point. So what you must know, that the nice thing of a cash flow statement question, it requires you to know everything. So that's going to help you to know whether you know everything. Okay, so use it as an opportunity to revise all the necessary topics. So very important to take note. So remember, the way you get to a cash flow statement, the way you get to the cash flow amount, we assume every balance, every transaction, we assume every transaction is on credit. So then we reconstruct the T account, and any missing figure would be the cash amount, because the only way that account can balance would be as a result of a payment being made. But obviously, to get the right balancing figure, to get the correct payment amount, you need to know every possible transaction that can go through that account. So like I made mention, in a PPE account, you have opening balance, closing balance. What can increase PPE is additions, is an acquisition of a subsidiary. So remember, when you acquire a subsidiary in the current year, you are bringing on 100% of the subsidiary's assets, liabilities, income, and expenses on a line-by-line basis. So if you acquire a sub in the current year and they have PPE, you'll bring that on. So what can increase PPE? An addition. What can increase PPE? Acquisition of a subsidiary. What can increase PPE? If you include borrowing costs. Okay, so borrowing costs are not applicable to CTA level 1. I don't think so, but it's definitely CTA level 2. What can decrease PPE? Depreciation, a disposal, impairment. Okay, and there may be some foreign transactions. Those are typical examples that would be. As you read through a scenario, you must be able to pick up which account it impacts. So in order to reconstruct, you would then be able to get to the missing figure. Okay, so generally additions will be the missing figure, and it will mean additions is going to be this over here. Okay, so just take note. So those are the things that you're going to need to be able to do. So when you read through a question, you want to now be able to see a ledger account in your mind for every line item. Okay, so that is basically over here. If you acquire a subsidiary, it is an investment from the group perspective. So what you'd have over here, we have to bring in the cash is there. Okay, the group incurred the cash. So if they made a payment during the current year, there's a cash payment happening. So you will have here investment in subsidiary. Okay, if you dispose of a subsidiary, so remember over here, we this must distinguish between the two over here. Under the financing activity is where there's an increase or a decrease in shareholding, but before and after you were a subsidiary. So that is a transaction with the owner. This one over here, when you become a subsidiary, you were not a subsidiary before. So it's not a transaction with the owner, so it comes under investing activities. When you dispose of a subsidiary, meaning you are a subsidiary, and after the change in ownership, you are no longer a subsidiary. That means you lost control. So that is a disposal of a subsidiary. So if you had a disposal of a subsidiary, that means if you do reconstruct the T account for PPE, PPE can also decrease as a result of a disposal of a subsidiary. So just take note of that. So remember, your investing activities would be your non-current assets. So if you have a look of the accounting equation, assets equals equity plus liabilities. Another way to write this is non-current asset plus current asset equal equity plus non-current liability plus current liability. So under the financing activity section, we included that. Under the financing activity section, we basically included equity and non-current liabilities, largely speaking. Okay. Under the and so if I can, yeah, let's just do that. Okay. So we just look for better colors. So that is basically, okay, so I'll just do this over here. Okay, so that is basically our financing activities. Okay, and the investing activities, largely speaking, it is the non-current assets, PPE, intangibles, investment property, investments. Remember, investments can be investment in sub, investment in associate, investment in joint venture, and just normal IFRS 9 investments. Okay. So just take note of that. So let's just make this also a color. Okay, so that is basically your so your investing activities is largely speaking your non-current assets. So what you could also have over here, if you acquired an investment, acquisition of investment. Now remember, when I use the word investment, then we're referring to the IFRS 9 investment. If it's a subsidiary or a joint venture or an associate, you call it subsidiary, joint venture, or associate. Okay, and then it could also be proceeds from sale of investment. Okay, so those are typical examples. Okay, so those are typical examples. For each of these, you will reconstruct a T account. Besides for the disposal of investment and an acquisition of besides acquisition, because remember the acquisition is just basically, remember when we calculated the consideration in the goodwill calculation, the cash portion of the consideration would be your acquisition of a subsidiary. We'll make a slight adjustment to it. Disposal of the subsidiary is whatever you sell the subsidiary for, but only the cash portion. Now pay careful attention over here. Remember, in changing ownerships, what did we do? We went, let's say we went from sub to a normal investment. So the subsidiary was 60%, then we sold 50% of our sub, so therefore we have a remaining 10%. What was our consideration? Do you recall our consideration? Remember, our consideration was two things. The consideration was the actual sale of the 50% plus the deemed disposal of 10%, the remaining interest. Always remember that remaining interest is a deemed disposal. It is a deemed acquisition, meaning there's no actual cash flows happening. So therefore, these amounts will not include that because we are busy with a cash flow statement. So we're only taking into account cash. So we will only look to the actual 50% sale or the actual 50% acquisition. So just be very, very aware of that. Okay, so once more, under the investing activities, like we said, typically under operating activities, you will include dividends and interest income. So the accounting standard allows you to include dividends received and interest received under investing activities if it relates to long-term investments. So typically a dividends received would be if you have an investment in shares, right? So if the company policy is to include dividends received under investing activities, you will include it under here. Similarly, you may have a long-term investment that earns interest. Okay, so for example, you invest in unit trust or something and it earns interest income because it has money market funds. So as a result of that, or you're just investing in a fixed deposit, so it's earning interest income. Interest income can be included under investing activities if it is the policy of the company. Okay, so just take note of that. So now we come to the last part, which is cash flows from operating activities. Okay, so cash flows from operating activities is broken up into two sections. Okay, so the cash flows from operating activities is broken up into two sections. The first section is basically cash generated from operations, cash generated from operations, cash generated or utilized. If it's a negative, it's utilized. If it's positive, it's generated. Cash generated or utilized from operations. Okay. And then you can have okay. So and then you can have everything else. Everything else is the following. Okay, so I'll just show you quickly. So everything else is the following. It's basically 5 things. Okay, it could be 6, but 5. Okay, so it can be interest. Everything else is interest paid, interest received, dividends paid, dividends received. Okay, and then tax paid or received. Okay, or received. Tax paid or tax refund. Okay, so one of the two. If it's a refund, it's an inflow. If it's a paid, it's an outflow. Everything paid is an outflow. Everything received or refund is an inflow. Okay. Now remember, interest paid is, these are generally under operating activities. If they're silent, you leave it over here. But if the policy is that interest paid will be under financing activities, it won't be here. It will be under financing activities. Same for interest received. It can be under investing activities. Dividends paid can be under financing activities. Dividends received can be under investing activities. So just be aware of that. Remember, interest paid that can be under financing activities is only interest paid relating to long-term finance. If you paid interest for bank overdraft and bank overdraft forms part of operations, then you have to leave it over here. Okay, the interest relating to bank overdraft. So just be aware of that. But this is basically the two parts: cash generated from operations and then everything else. So the question would be, how do we get cash from operations? So cash from operations can be determined in one of two ways. Okay, cash from operations can be determined in one of two ways. So you have two methods. You have the preferred method, and then you have the other method. Okay, so you have what IAS 7 calls the preferred method or the other method. What is the preferred method? The preferred method is the direct method. The other method is the indirect method. So remember, if they tell you, dear student, prepare the cash flow statement using the preferred method, then it is the direct method. The other method is the indirect method. What's important to take note, if you prepare the cash flow statement, operating activities using the direct method, then as a note disclosure, the indirect method is required. However, if you prepare the cash flow statement using the indirect method, then there's no need to do the direct method. Okay, so when you do the direct method, you must do the indirect method. And the direct method is the preferred method. So what you can know, that most likely the question is going to ask you for the direct method, because then by default, the indirect method, note disclosure, is required. Okay, so the direct method will look as follows. Cash received from customers, cash paid to employees and other suppliers. Okay, so that is basically it. So just take note of that. So once again, the operating activities is basically going to be any working capital, any operating assets, any operating liabilities. Typically, current assets and current liabilities all relate to operating assets and operating liabilities. But don't just think it is like that. Okay, so just take note, it must be made clear. If they are silent, you can assume so, but if they're not silent, then you can't assume so. Okay, so just be aware that operating activities is your operating assets, your operating liabilities. Trade receivable is an operating asset. Trade payable is an operating liability. Inventory is an operating asset. Prepaid expenses is an operating asset. Accrued, not all accrued income, not all accrued expense. Accrued income and accrued expense could relate to interest paid, interest received, dividends paid, dividends received. So just be careful on that. But just be aware that typically all current assets and all current liabilities will relate to these things over here. Okay, so what you must know that this is in effect, this over here is in effect a cash flow income statement. Okay, so this over here is basically a cash flow income statement. The income statement, it records all income and expenses based on the accrual concept. The income statement records income and expenses using the accrual on the accrual concept. The accrual concept says income is you record income when it is earned, irrespective of whether cash is received or not. The accrual concept about expenses says expenses is recorded when incurred, irrespective of whether the cash is paid or not. Okay, so the income statement records income and expenses on an accrual concept. Income is recorded when it is earned. Expenses is recorded when it is incurred. The cash flow statement is basically trying to show you the cash flow transactions. So what you must know, the balance sheet, the opening and closing balance of the balance sheet is the difference between cash and accrual. So when there is no balance sheet line item for a particular item, then the cash and the income statement will be exactly the same. So I'll give you an example. So the accounts that impacts cash received from customers is basically debtors and sales. Okay. So when you reconstruct this account, you do the following. You always set up an account based on a balance sheet, and the transactions would be all the income statement line items. Okay. So your balance sheet, if there's no balance sheet account, you can't reconstruct an account. Okay. So basically to look like this. I'm just going to give you one example just to bring so you can understand the concept. So the accounts that we use when it comes to cash received from customers is debtors or trade receivables. Okay. But not, remember, when they give you trade receivables, you must make clear that when you work out cash received from customers, you only include trade receivables relating to debtors, because trade receivables can include other stuff as well. Okay, so debtors. We will have an opening balance. As an asset, the opening balance is on the debit side, and automatically the closing balance of an asset is on the credit side. What can increase debtors is sales. Remember, the assumption is that everything is on credit. What can decrease debtors is bad debts. Okay, what I just want to make it over here, I don't want to just say sales, I want to say net sales. So net sales is less credit returns. Okay, so credit notes. So net sales, less returns. Okay, bad debts, the missing figure will be cash. So let's say net sales is R1 million. Just for this example, we can assume there is no bad debts. Okay. Remember, every T account needs to balance. So what you must know, let's say there's an opening balance of 100,000 over here. There's a closing balance of 180,000. Bad debts is 0. So the balancing figure would be bank. So remember, bank is on the credit side of debtors. So therefore, on the bank account, there's a debit to bank, meaning bank went up because debtors paid us. Okay, so the missing figure over here, in order to get to 1.1, will have to be 1020, I think. 1020, no, 980. Okay, no, 920. Okay, so must be 920. So as you can see, the sales, which is the income statement, is 1 million. The bank for sales, the cash sales, was 920. Why is there a difference? Because there's a balance sheet line item. So if there's a balance sheet line item for a balance, there will be a difference between cash and accrual. But the moment I remove balances, there's no balance sheet line item. What you will notice is that in order for the account to balance, bank will also be 1 million. So accrual and cash will be the same. So what you must know, if there is a balance sheet line item relating to a transaction, then the accrual and cash will not be the same. The moment there's no balance sheet line item, then the accrual and cash will be exactly the same. So the difference between what is sitting in the income statement and what will go through the cash flow statement is as a result of there being opening and closing balances on the balance sheet. So just be aware of that. Okay, we will go through this in much more detail in an example. I need a full 2 hours to go through an example from start to finish with you. So that is why I thought I'll just give you the background, and then we will do the rest. Okay, just one more thing. Remember, this is the operating activities can be done in 2 ways, using the direct method or the indirect method. This is the direct method. Remember, the only thing that the direct method and the indirect method impacts is this line item over here, cash generated or utilized from operations. So the only thing that the direct and indirect method impacts is how you calculate cash generated from operations. Whether you use the direct method or the indirect method, the number will be the same, but how you get there will be different. So how we get there for the direct method is cash received from customers minus cash paid from employees and other suppliers. Okay, whereas under the indirect method, what do? We do the following. Okay, so under the indirect method, to calculate cash generated from operations, we will start off with a profit number, any profit number. Okay, so let's just say we start off with, they typically going to tell you which number to start off with, and they typically tell you to start off with profit before tax. Okay, so then so now profit before tax is an accrual number. We want to get that profit before tax to a cash number, but not any cash number. It must be an operating cash number. Okay, so remember what we're trying to get to? We're trying to get to that number over here. Now, if you look very carefully, this number over here excludes anything relating to this. Okay, so anything in profit that includes these numbers cannot be in that number. So therefore, we make 2 types of adjustments. So this profit number, profit before tax, is an accrual number. We want it to be a cash flow number. So the first type of adjustment is adjust for two things, okay? The first thing is non-cash flow. So a typical non-cash flow is impairment. A typical non-cash flow is depreciation. The second, the second is adjust for items disclosed elsewhere. Now, what do we mean by items disclosed elsewhere? Remember, we're trying to get to cash generated from operations. So items disclosed elsewhere is everything else. Okay, so items disclosed elsewhere is everything else. For example, in profit before tax can be interest income. But interest income is not included over here. It is below this line. It is disclosed elsewhere. Included in profit before tax could be interest expense, but interest expense is not included in cash from operations. It is disclosed elsewhere below cash from operations. Another typical example. Included in profit before tax could be a profit or loss on the disposal of PPE, but the disposal of PPE disclosed elsewhere. Where is it disclosed? It comes through in investing activities. So therefore, we must remove it. So what's important to take note is to understand what we're trying to calculate. We're starting with profit before tax. That includes non-cash flow items, and that includes items that are disclosed elsewhere. What are the items that are disclosed elsewhere? Anything relating to financing activities, anything relating to investing activities, anything that is below the operating, that is included in operating activities, that is below the line item cash from operations. So what is below cash from operations is interest, dividends, tax. What is in investing activities? A profit or loss on the sale of PPE, things like that. Okay, so that is items disclosed elsewhere, and you always remove any non-cash flow item. This will give you cash flows before changes in working capital. Okay, now I must bring in working capital changes. So remember, like we said, that the difference between income statement and cash flow would be as a result of the balance sheet. So the balance sheet may have an opening and closing balance of inventory, that's working capital. It may have an opening balance of debtors, trade payables, prepaid expenses, and so forth. So what you must know, you will have to bring in increase or decrease in debtors. Okay, I'm just going to bring in the typical ones. Increase or decrease in inventory. Let's do that. And then increase or decrease in creditors. Okay, so these are the typical ones. There can be anything else as well. So if we get a question and we have something, I'll show you. Okay, and then these adjustments would then give you what we are looking for, which is cash generated or utilized from operations. In most questions, they're going to ask you for both. So you will be able to tell whether you got your cash from operations correct, because if you got it correct, this answer and that answer must be the same, which is the same number, just calculated differently. Okay, so that's all I wanted to cover for tonight. Well, just a big picture overview of cash flows, and so you can get your thinking right. And then in the next lesson, I think I scheduled it for Saturday, we will go through a full-on question. By tomorrow, I'll send you the question I'm going to select, of the one we're going to cover, so you can at least familiarize yourself with it, or even attempt it, but at least familiarize yourself with it. And then we can cover it together on Saturday. What's going to be useful about it? There will be change in ownership. So you will be able to revise change in ownership. And because remember, for CTA level 2, we're going to do foreign subsidiaries. You need to know change in ownership, and you need to know normal groups inside out. before we do change that foreign subsidiaries. Okay, so we must be very strong on changing ownership, and must be very strong on normal groups in order for foreign subs to be easy on you. Okay, so I'm going to stop over there. Is there any questions from your guys' side? Ashita, Bernice, Fakir, anything your side?
No questions.
Ryan, Tandi, Valise?
No questions.
No questions.
No questions.
Tandi? I'm happy you found it useful and beneficial. So now we can apply this thinking when we do the actual, then you're going to see how it all comes together. If there's anything still confusing, try to rewatch the video. But if it's still okay, then I'm going to send tomorrow when I send out the video. When I tell you that the video is uploaded, I'll also tell you which question we're going to cover. So you can attempt it, or at least familiarize yourself. Then you're going to see how all of this comes together. For CTA level 2, normal groups and changing ownership is very important to make sure you know it. So we're going to use that as also an example, as an opportunity to somewhat revise those aspects. Because when we come to foreign subs, you want to be fairly solid on those two aspects. But that's it from me from my side. I'll see you guys tomorrow for the masterclass. Okay, bye-bye.